Good morning, everyone, and thank you very much for joining me. This is the morning market review. My name is Russell Shaw. I am a senior market specialist at FXCM. Today is Tuesday, it's the 17th of January 2022. My email address is r@fxcm.com. I'm just going to go ahead and bring up our disclaimers. Can I just double check, just get the 3 yeses? Can you see me? Can you see the screen? And can you hear me? Okay, thanks, Howard. Howard's got in ahead. Excellent. All right. I'll just keep this market commentaries disclaimer up for a moment. All right. If I'm not looking directly at the camera, I'm just working with two monitors, so I'll try to look at the camera as often as I can. Here is the and I don't think I showed the high risk investment warning. I just want to put the high risk investment warning on first, and then we shall go through to commentaries, which I think I had up. And here is Francis Market Scope and tradingview.com. Hey, Shadrach. Okay, noted. Yeah. All right. What I wanted to show you guys first, this is just something I found interesting. I don't think there is. Where's my chart? There we go. I don't think there's anything to take away. This is after the fact. There's a head and shoulders on Tesla here. It's after the fact. I just want to put the neckline in. Okay. Let's put it in there. Yeah, that's good. Just want to make sure this is logarithmic. It is. Okay, let's just put in the head and shoulders here. All right, here's the head. All right, and just the right shoulder. And I just want to show you the targets being hit here. So again, technical analysis targets are very, in my opinion, are very problematic. There's a lot of questions. Should you use arithmetic scale? Should you use logarithmic scale? On a logarithmic basis, we've hit the target here. Just about. Sometimes they get hit, sometimes they don't get hit. What I think the targets are actually useful for is that they give a directional bias. Whereas if we want to use a forecasting technique and we're using technical targets, we might become beholden to the target and then sort of filter out information so that we're only seeing what we want to see. So it's not something that I think that we need to use. But I just thought this was one of the examples. Tesla hitting its head and shoulders target. The question now is, well, is it a buy? Is it still a sell? I think that what we can do here is perhaps take a look at this in terms of the Stan Weinstein model, which, just to give you an idea, Stan Weinstein wrote a book in 1987 called How to Profit in a Bull and a Bear Market. It's a very, very cheesy type of title, but the book is phenomenal and it's really stood the test of time. I often go back just to reread it. I think it's a terrific book. In fact, it was, I think, the first book I read, and I didn't realize how effective it was until much later on in my sort of journey. Let's just put this as red. I'm going to just write in here distribution. So it's head and shoulders. I think what we can do is we can look at this as a distribution pattern. This comes straight out of the how to profit in a bull in a bear market distribution. And what Weinstein does is he adds in a 3-week exponential moving average. I think in the book he calls it a weighted moving average. We're going to use an exponential moving average. All right, we want to just change this to 30-week. I've also come across a 34-week. There was an analyst study through, but unfortunately he's passed. He used the 34-week. The 30-week. See, the 30-week is still on top of the price here, and the 30-week is moving down. So we can use the 30-week as a filter here. In other words, if price crosses above or below, that's sort of step 1. Step 2 would then be the directional filter in terms of the moving average. Now we can add something else here. We can add volume. Now we're on a weekly chart here, so I want to just show you a volume indicator that I think is very good. I'm going to put it in here. It's called on balance volume. Now there's something we've got to do with OBV. We can't just use it. Okay, something very easy to do, but it must be done. On balance volume must be used on a daily. Okay, you can't do it on a weekly. You can't use it on a monthly. It must be used on a daily. I'll tell you why in a moment. But if we're going to go down to the daily chart, then we've got to change this from 30-week to 150 day. Just times it by 5. And then we can go down to the daily, and we should get sort of a similar type of reading, which we do. All right. And this is the volume. Nothing really to jump out at me. What we're going to do here is, I just want to double check. We're using the NASDAQ volume. Okay, good. All right. So the reason you've got to use unbalanced volume on the daily chart is the way that it works is it's additive. So it starts at a number. The number that it starts, it's not really important. So let's just say we start at 0, which is a logical place to start. Let's say on day 1 there is 100 shares that are traded, and the stock trades up. Then we would add 100 onto 0. On day 2, if there's 50, we'd add 50 onto the 100. On Wednesday, depending if the stock is up or down, we would either add or subtract the volume. So on an up day, we add stock to the unbalanced volume. On a down day, we would subtract it. Now, the reason why we use it on a daily is, imagine that you've had 4 days of gains of 100, 100, 100. And let's say the total gain has gone from 10 to 11. Okay, so it's just 4 days of slight increments up, but the volume has accumulated by 400 units. And let's just say on Friday, we drop, let's just say we drop from 11 to 9. So remember, we started at 10, we went to 11 from Monday to Thursday. And then on Friday, for some odd reason, maybe it went ex-dividend, it goes from 11 to 9, but only, let's say only 50 units are traded. So we've got 400 units, Monday, Tuesday, Wednesday, Thursday, so 100 on each day, minus the 50 on the Friday takes us to 350, but we've got 350 of accumulation. But on a weekly chart, it would actually subtract that volume, because on a weekly basis, it's showing a negative week, which is not correct. It's an accumulation. So unbalanced volume must be used on daily. It's very important. And then what you want to do is you want to see if there's any sort of accumulation or distribution. So what we can do here, just to give you an idea of the unbalanced volume, well, let's put in a trend. Okay, and we can actually shift this trend down. Here you can see where the distribution actually really kick in. There's a shift down. And we can start now monitoring to see the volume starting to accumulate, and if the candlesticks actually take out the moving averages, and we start using the phase analysis, Stan Weinstein's phase analysis. So this is an interesting way to keep a track of Tesla. Now, the volume analysis is super important because by and large, it's going to be fundamentals that are going to be driving the stock here. It's one of the most fit stocks on the market, as you can imagine. And what will happen is when the fundamental analysts start seeing this as a buy, it will reflect in the volume. So the volume, when the volume starts ticking up, well, that's activity generally from the fundamental side of the market. So this unbalanced volume gives us a really nice peek into the real fundamentals that are driving the market. Now, what I want to show you is another instrument I've been looking at. It's actually a basket, an FXCM basket. And what we're going to do is we'll take a look at it still on TradingView. And it is the China Tech basket. So let's bring that up. So there's four 10-cent is in here, Alibaba is in here. I can't remember the other two. They're on our website. China Tech. Where is China Tech? Yeah. There we go, China Tech. All right. Let's bring it up. All right, now take a look at this. We are looking at a 30-week, except it's daily. So this is the 150-day. Okay, it's the 150-day. Now look at the accumulation here. Okay, you've got a lower trough here. Let's put this in. You've got trough, and you've got your lower trough. Okay, take a look at this. Trough, lower trough. So there is price moving down. There is price moving down. Look what we've got here. Look what we've got here. Here we've got a divergence. Here you've got a trough here. Okay, and here you've got a higher trough. Okay, so somebody seems to be picking this up. Now, another way we can do this is with trend lines. Okay, you can take a look here. Let's draw this trend line down. Okay, there's the break. So there's a V reversal here. We've got a really nice V reversal here, and it's been accompanied by volume. Now, what we can do just to really round this off is bring in a longer term volume trend line. And you can see we right near sort of break the longer term distribution. And this is actually not a valid, sorry, it has to go down here. Sorry, I beg your pardon. This is the valid trend line. That's the valid trend line. It can't go to this trough. It can't go to this peak here because we've got a higher trough there. You can go here because we've got the lower trough. So you can already see that we are seeing some sort of accumulation in the China tech. I feel my explanation was very loose with regards to the trend line. I just want to go through that with you guys again. Trend lines, you can't just draw a trend line, okay? There is a specific technique to trend lines, and it's in the name. A trend line must measure a trend. If there's no trend, you can't have a trend line. Okay, what's a trend? A trend is a series of peaks or troughs. In a downtrend, it would be lower peak followed by lower trough. So this is a higher trough. So there's no trend, there's no downtrend here because we've got the higher trough. We can only connect the lower peaks and the lower troughs. So the lower peaks have to be validated by the lower troughs. I hope that makes sense to you. It's very, very important. Okay, it's very important to get because a trend line effectively is a momentum indicator. It measures the rate of change. So here you can see we've got a accumulation, and then if we had to go back to Tesla, okay, you can see that we haven't got that accumulation picking up just yet. Now the question is, okay, why is the unbalanced volume picking up in China tech? Okay, that's very, very pertinent to this discussion because it's the volume that effectively is reflecting the fundamentals. Well, what are the fundamentals? Well, there is a reopening of the Chinese economy, and there seems to be an indication that the regulatory pressure that the authorities were putting on tech companies is being relaxed, and that was discounted very quickly into China tech. You can see there's a V reversal here, and now we've got a movement into a markup phase. Okay, so you can see there's this movement over here. Howard saying, will the Bank of Japan rate of decision affect the indices? I don't think it will affect the indices per se. What it will affect would be the Japanese yen. Let's take a look at that. That's a good question, by the way. It's one of the biggest stories. Let's just go through to this. So here is the time check on my market scope. I'm just going to go through to the US dollar Japanese yen. Okay, right, take a look what's happening here. Okay, take a look what's happening here. Let's look at this in terms of the Weinstein methodology. Okay, so you've got your accumulation here. This is all accumulation. Okay, and that is accumulation of US dollar versus the Japanese yen. Well, now you've got distribution. As the distribution, and it's like there was a V reversal, a V bottom. Here's a V top. Now these are very rare. V reversals are very, very rare. Okay, so here you've got this V reversal. It means that the market is discounting fundamentals at a very swift, very rapid pace. So what's happening here is the market is expecting the Bank of Japan to relax its defense of its 10-year bonds. Let's take a look at that on TradingView. Let's get rid of the unbalanced volume. We won't need it. So what we can do here is put in the JP10. Why? That's the JGBs, Japanese government bonds. Let's bring that up. And what effectively is happening here, sorry, let's just get rid of logarithmic here. Yeah, there we go. All right, and let's get rid of this moving average. So this is a highly manipulated market. So what happened was the Bank of Japan was defending the 25 basis points level on the Japanese yen. In other words, every time the yield was going to go past 25, what they did was they just bought bonds. They bought bonds and just pushed the rates down. So it was very much a manipulated type of market. And then they shifted that to 50 basis points. And they reckon tomorrow this 50 might be cancelled altogether. I'm not certain exactly if they will cancel it or not. the market seems to be suggesting that it is going to be cancelled. Now, this is the problem with trading these heavily manipulated currencies, is that, well, if you're going to go long Japanese yen, okay, in other words, you believe the US dollar Japanese yen is going to go further to the downside, you would be on the right side of the Stan Weinstein distribution pattern. And let's say you've got this short position on US dollar Japanese yen. So you short US dollar, you long Japanese yen. That's actively sort of what we would expect to be the right position, assuming, now this is a capital I, capital F, if the Japanese yen do decide to abandon their defense of 50. What happens if they don't? What happens if they double down? Now, I don't know what they're going to do. The market seems to be thinking that they are going to be relaxing. Let's just say they don't. Well, then the market goes heavily against you. And even if you've got a stop loss in, it's going to be so fast. By the time your stop gets triggered, you're going to have huge slippage there. So the idea here is to be very, very careful when there is a heavily manipulated currency, because it's very difficult to tell what these decisions are. Whilst we do have an idea of what the market is expecting, if it doesn't go the market's way, there's going to be a very, very big reaction. All right, let's just do the DAX and the Euro, and then if there's any questions, you guys can go ahead and type that in. Let's just take a look at DAX first. So we did this yesterday. I like the DAX. It's got this higher trough, higher peak. We go down to the daily. It's trading nicely in zone 1. Look at the momentum here, such strong momentum. Okay, we go down to the hourly chart, and what we've got here is the supports holding. Okay, supports holding. So we've looked at the support now for the last 2 days. There hasn't been any swings, and this is a really good learning opportunity for us. We've got a trigger 1. We've got a trigger 2, so the triggers have been pulled. Does that mean that the trade is going to be successful? No, it doesn't. In order for the trade to be successful, we have to get through to the upper quintile and hold. We got to the upper quintile here, and it fell out. Hit it and fell out. No swing. Okay, you need it to hit and hold. It hits and holds, then you get your swing. Okay, so we've got 2 of the 3. We've got trigger 1, we've got trigger 2. Now we've got to wait for number 3, because we don't know if we're going to get number 3 or not. Must have stop losses, must have risk management if there's something that appeals to you. Let's just go through to the Euro. Okay, similar story here. Trigger 1, trigger 2. Do we get the 3rd requirement here? I don't know. See, it hit here and fell. Hit and fell without holding this upper quintile. It's not going to work out. Let's just take a look at the daily chart. Daily chart's looking terrific, and the weekly chart's looking terrific. All right. If there is any questions, please go ahead and type this in. Tomorrow we're going to do a morning market review. We'll end at the top of the hour, and then we're going to do a crypto minute. So please join me for those 2 webinars tomorrow. All right. Okay, no questions coming in. Let's wrap up here, guys. Thanks very much for joining me, and have a good day and a good evening ahead. Cheers now.